This video about should I invest or pay off my mortgage? Let's start. If you have received a windfall of cash or saved a sizable sum of money over the years, it may be tempting to pay off the mortgage loan early. Whether or not paying off the mortgage early is a good decision or not can depend on a borrower's financial circumstances, the loan's interest rate, and how close they are to retirement. Another consideration includes whether to invest that sum of money versus paying down the mortgage. This article explores the interest cost that could be saved by paying off a mortgage 10 years early versus investing that money in the market based on various investment returns. Key takeaways. If you have received a windfall of cash or saved a sizable sum of money over the years, it may be tempting to pay off the mortgage loan early. Whether paying off the mortgage early is optimal can depend on the borrower's financial situation, the loan's interest rate, and how close they are to retirement. Also, paying off a mortgage has benefits. Consider other factors such as the tax deductibility of mortgage interest and low loan rates. Investing that money may generate higher returns than the loan's interest cost, but markets also come with the risk of losses. How a mortgage loan works. A mortgage is a loan to a borrower for the purchase of a property or home. When all of the legal documents are signed during the mortgage closing, the borrower signs the loan documents and agrees to repay the mortgage lender in monthly payments until the loan is paid off. Typically, the loan term is 15-30 years. In return, the financial institution pays the seller the full price of the home and in exchange charges the borrower interest on the loan balance. Principal and interest. Mortgage payments are made up of two components: interest on the loan and principal amount, which goes to paying down the total outstanding balance. For example, a $1,000 monthly payment might have $300 to go to interest and $700 reduce the principal loan balance. Interest rates on a mortgage loan can vary depending on where interest rates are in the economy and the borrower's creditworthiness. Amortization schedule. The loan payment schedule over a 30-year period is called an amortization schedule. In the early years, the payments for a fixed-rate mortgage loan are mostly comprised of interest. In the later years, a larger portion of the loan payment is applied towards reducing the principal. The table below illustrates 5 loan payments at different intervals for a 30-year mortgage with a starting balance of $200,000 and a fixed interest rate of 3.5%. Let's keep this. The table above shows that a larger portion of the fixed monthly payment went towards paying interest for the first 10 years. However, as time went on, the percentage of the monthly payment that went towards interest versus principal reversed. For example, in the 20th year, $611.45 went towards principal, while $286.64 towards interest. For the last payment, all but $2.61 of the monthly payment went toward paying the principal balance. The portion of the loan payment that's applied to principal and interest changes over the years because the loan balance is higher in the early years and smaller in the later years. This makes sense since the interest amount is higher early on, since there is a larger loan balance outstanding. As the monthly payments eventually reduce the outstanding loan, there is less interest owed, leading to a smaller portion of each payment being applied towards interest and more towards the principal. Paying off the mortgage early. Some homeowners choose to pay off their mortgage early, and the benefits can vary, depending on a person's financial circumstances. For example, retirees may want to reduce or eliminate their debt since they are no longer earning employment income. In other cases, people may want to free up their monthly cash outflows by paying off their mortgage. Mortgage loan examples. Let's skip it. Let's go talk about investing in the market. If a homeowner is considering paying off their mortgage early, it might be worth considering whether some or all of those funds would be better off invested in the financial markets. The rate of return earned from investing might exceed the interest paid on the mortgage for the final 10 years of the loan. In other words, the opportunity cost, meaning the foregone interest that could be earned in the market, should be considered. However, many factors go into evaluating an investment, including the expected return and the risk associated with the investment. Investment gains versus loan interest saved. If a homeowner decided to invest $100,000 versus paying down their mortgage in 10 years, they would earn $22,000 based on an average rate of return of 2%. In other words, there would be no material difference between investing the money versus paying off the 3.5% mortgage. However, if the average rate of return was 5% for the 10 years, the homeowner would earn $62,000, which is more money than the interest saved in all three of the earlier loan scenarios. Whether the loan rate was 3.5%, 4.5% or 5.5%. With a 10-year rate of return of 7% or 10%, the borrower would earn more than double the interest saved from paying the loan off early, even with using the 5.5% loan rate. The power of compounding. One of the reasons for such a difference between the investment gains and the interest saved from paying the loan off early is the power of compounding. If the $100,000 investment is not withdrawn during the 10 years, the interest earned each year is reinvested, leading to interest being earned on interest, which can magnify the investment gains. Risk tolerance. Before investing money in the market, it's important for investors to determine their level of risk tolerances, which is the amount of money they are willing to risk in order to make an investment gain. We will end on it. Goodbye.